Let's get started. So first we'll go through the housekeeping items, always exciting for everyone. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. The other thing is that if you are in New Zealand and you would like a copy of our FAP, you can go on our website, morningstar.com.au, and find a copy of that. And also, if you would like some personal financial advice over in New Zealand or anywhere, you should reach out to a financial advisor. Okay, so let's get started. So today we're going to talk about books. So I have 5 books, and I read them all, which is a miracle. But hopefully, I think this thing may be relatively short compared to the other ones, unless, of course, you have questions. So if you want to save me from going back and working on our budget for next year, ask questions. But we're going to talk about, I guess, 4 books and 1 essay, books that I've enjoyed and have informed the way that I invest. So hopefully things that you guys have read or potentially things you might want to read. So let's get into this. Oh, that's the wrong title. We'll just skip that. Okay, so we're going to start talking about books. The first couple of books we're going to talk about are more overall kind of looking at the market and overall philosophy about what's going on in the market. So we're going to talk about an older book, as you can see, published in 1923. And the key lesson here is that, yes, reading this, of course, things are not directly applicable to what we're doing now. We're obviously looking at a very different time. And basically what we're looking at here is we're looking at a book that was sort of loosely put together around the life of a real life stock trader. So Jesse Livermore. And he was one of the most notorious traders of all time. And what the book really sits there and walks through is somebody named Jesse Livingston. So obviously just a name that we're using in the book, and his career as a trader. So basically what happens is he goes through these different phases, different approaches to trading, goes broke a bunch of times, manages to bounce back. And just from his interactions with other traders on here and other people he sort of deals with in his what eventually becomes more of a Wall Street career, we get a bunch of different lessons about investing. So the biggest takeaway that I took from this book, and I think most people did, is really this difference between speculation and investing. And we hear about this all the time. So it's the same thing we hear about in The Intelligent Investor, which I did not include because it's on like every single list that we ever hear about investing books. But really important distinction, and I think a really important distinction right now as well. And I'm not saying anything bad necessarily about trading or speculation, but it is just not investing, and it's very different. And I think the problems that many people run into is that as investors, they are comparing themselves to speculators and judging themselves against speculators and really confusing those two different concepts. So once again, what is a speculator? A speculator who is somebody who goes out and buys a security with the notion that they are, of course, going to turn it around and sell it to somebody for a higher price. And that price can be based on all sorts of generally short-term things that happen, generally around other speculators. So I think we're seeing this a lot in sort of the fringes of the market, if not more of it right now, where we are hearing about all these tips, all of these different things that I believe are very overvalued, that people are chasing. And they're chasing not because they understand or even thought about the underlying value of what they're buying, but just because there's this notion that it will go up in price. And we often see this, obviously, at the top of bull markets, because when stocks have not gone down for a very long time, for a lot of people, it is just not something that they actually consider as an outcome that's going to happen. So we do see a lot of speculation at the top of the market. And this book is really about speculation. And I really like this quote that's from the book. And he's sort of looking at this concept of what is not a speculator? Well, men who can both be right and sit tight. So basically, at the end of the day, focusing on value, finding something that you actually want to purchase, and then, of course, waiting until value and price actually come together. And maybe that's a little harder to find in a market that is rather overvalued at this point, but that is the key to investing. So it's that focus on value, and yeah, the rest of the quote is pretty good as well. But I think sort of this notion around this. And he's, of course, talking about before they created, before decimals started to be used for security prices, and they used to be traded in eighths. But yeah, just what are the most expensive eighths to go after is, yeah, trying to get that last eighth, or of course the first. But my view, I think a lot of people's view, we might be in a situation right now where we are all chasing that last eighth. And you see this all the time. I got sent a message by Shani earlier today from an investing board where somebody's recommendation to find an ETF was to Google the ETFs that are the best performing ones and simply buy those. I think that's certainly behavior, maybe just out of ignorance, but also just trying to chase that last eighth. So yeah, I liked that. I like that quote. There are a couple other things in this book where he does talk about, obviously, this difference between speculation and investing. So he says speculators buy the trend, investors are in for the long haul. They are different breeds of cat, in case you're into cats. And then a couple other lessons I thought were really interesting is, number one, there is, of course, this notion of this time is different. So we hear that all the time, of course, at market tops. And he says, another lesson I learned early on is that there's nothing new on Wall Street. There can't be, because speculation is old as the hills. Whatever happens in the stock market today has happened before and will happen again. So, you know, I think particularly people that either have not experienced a bear market before, or perhaps have forgotten what a bear market is like because we've been on such a run, there is, of course, this notion that this time is different. All right, so okay, we've got a good question. We've got a good question from Steven. So the first and the last eighths are the most expensive. What are the best value? So basically what he's talking about there is trying to sort of catch markets as they turn. So, you know, I think trying to catch, if you go back and sort of look at, if you look at those two situations, so what is the first eighth? Well, it's you trying to quote unquote buy the dip. And sort of grab the bottom of the market. The other one, of course, is trying to get that last eighth before it turns. So yeah, I mean, you know, I think from my perspective, if we sit there and focus on value, what are we kind of concentrating on then? Well, we're concentrating on the long term, not trying to make these, you know, quick little trading terms or trading profits at both ends of the market, but we're focused on the long term. We're focused on value, and we are less worried about an eighth, of course, because we're long-term investors, and we know over time, and we'll get into some other books that talk about this, we know over time, as you compound and accrue dividends and reinvest those dividends, that is the way that we build long-term wealth. And then one other lesson I did like from this book is there is this notion that sometimes it's important to do nothing. And we've talked before about action bias. So action bias is, of course, something that impacts investors, the need to always do something. So action bias is comes from this whole fight or flight, you know, natural reaction that we have to any sort of danger. But yeah, sometimes it is certainly best not to do anything. And you don't have to, right? If you're focused on the long term, and Warren Buffett, and of course, it's a baseball analogy, which doesn't really resonate that well in Australia, but Warren Buffett has this quote around waiting for your pitch. So basically sort of the notion that you can take an infinite amount of pitches. It's actually a better cricket analogy, right? Because in baseball, you can strike out looking. Yeah, it's a better cricket analogy that you wait for your ball. You don't have to, especially if you're in a 5-day test match, and I'm probably running out of my cricket knowledge here. You don't have to swing at every ball. You have to wait for the one that you actually want to play. And it's the same notion, right, in investing, that you don't have to swing at every pitch. You don't have to swing at every ball. You can wait for ones where you have an advantage as an investor. All right, look at that. We made it through one book. All right, so this one's not a book. Now, the good thing about this not being a book is that it's really easy to read. So I printed it out today, which only does me good since I'm the only one in the office. But yeah, The Super Investors of Graham and Doddsville. So it's an essay by Warren Buffett. I was trying to get around this whole having anything from Buffett, but I thought this was good, and it's short, which is nice. So what is this? So basically, Buffett went back to Columbia Business School, where he got his MBA and responded, and this was in the early 80s, and responded to what at the time was sort of the prevalent notion around investing, basically the efficient market hypothesis. And efficient market hypothesis is that security prices always reflect values. So it's making a couple big assumptions here. So the one thing that's assuming, of course, is that we have perfect access to information as investors. Now, in 1984, that definitely wasn't true. You could argue now that information is disseminated via the internet. Maybe we do have perfect access and instantaneous access to the same information. But then the part that makes no sense is that we all need to rationally interpret that information and apply it to security prices. So the efficient market hypothesis has sort of gone out of style and really been replaced by more of a behavioral view of investing, really centered around the notion that we are not rational and we do not make rational decisions, particularly in times of stress. So that would be, of course, at market tops, where an overvalued market turns into a bubble. And of course, at market bottoms, when fear takes over and people sort of jump on the selling bandwagon. But anyway, what this essay is, of course, is a response to that original efficient market hypothesis. And he kind of starts off with a pretty simple lesson. So he starts out with this coin flip scenario, which is referred to in this quote. That's the flips on there. So basically he says that there are 225 million people in the US. He said if every American woke up in the morning, walked outside and flipped a coin and bet $1 that they would guess if the coin landed on heads or tails. So they just had to guess correctly. Now, of course, nowadays, probably everyone would argue in the US about if it was heads or if it was tails, and no one would get past that first coin flip. But anyway, the idea is every morning you go out there, you flip the coin. If you call it correctly, you bet your $1, you win $1 from someone else. If you called it correctly, next day you come out, you flip the coin, you bet the $2. You get it correct, you keep going and going and going. So you're basically doubling your money every day. So after 10 days, there'd be 220,000 people right that call 10 flips in a row. And they would have all won more than $1,000, which is pretty good. In another 10 days, there would be 215 people left. So now they've called the right coin flip 20 times in a row, and they all have over $1 million. And this is where Buffett starts talking about, well, all of a sudden, what are these people going to do? They're going to start writing books, and they're going to go on to webinars, and they're going to tell everyone else how they are genius coin flippers and can call this stuff. But with a coin flip, of course, we all know it's dumb luck. But then he starts talking about what if all of those people happen to be from like the same small little town. And the analogy, of course, is that he's using, and particularly because he's doing this at Columbia Business School, is he's talking about the super investors of Graham and Doddsville. So Graham, of course, Benjamin Graham, who wrote The Intelligent Investor and Security Analysis. Well, Dodd was also a professor at Columbia who doesn't get as much credit, but he was a co-author on security analysis, which is kind of a textbook as well. And so really what Buffett's talking about, of course, is that, and he follows around the rest of the essay, is kind of case studies of individuals who had done very well against the market, basically saying the efficient market hypothesis crew wants us to believe that the only way to beat the market is luck, right? If everything is perfectly efficient, the only way to beat the market is luck. And what Buffett is arguing is no, because if we go back and we look at this sort of intellectual tradition, I guess, started by Graham at Columbia, that all of these investors that have roots to Columbia and to basically the value investing approach put out by Benjamin Graham have all done significantly better than the market. So it is not luck. It is the approach you're going to take. And he goes on also to talk about how all of these investors are, really at the end of the day, focused on sort of value and price, but go about it completely different ways. So they take different approaches. The definition of value is very different. So remember, Buffett moved away from sort of the very traditional Ben Graham approach to investing, which was like deep value investing. Instead, moved, and was still in a transition in 1984, but moved into more of the notion of buying great companies, but still focusing on value. And one of his favorite books, which I'd include in here, is Common Stocks, Uncommon Profits by Philip Fisher, and he was a growth investor, but once again was concentrating on value, but value out of growth stocks. But, the big lesson I think that I put on here is sort of this idea about kind of edge and efficiency, right? So if the market is not efficient, and it's not efficient because humans are not rational, then how can we as investors, particularly, investors that are out on our own doing this, how can we think about edge? So edge, of course, is the advantage that you have over other investors. And you need, of course, edge to beat the market. And if you're out there picking individual shares, that is sort of by definition what you're trying to do. And the idea, of course, is if you want to beat average, you can't do what everyone else is doing. And hopefully this gives you a little bit of I don't know what I want to call it, a little bit of a backdrop that would help you do this and go against the crowd, because that's very, very difficult to do with anything in life, let alone investing. So that's kind of what I took away from it. And those that have been on here before know that I think some of the biggest sources of edge that we have as investors that are out there on our own is that we have behavioral edge and, of course, structural edge, meaning that we can be longer term investors when most people, even if they say they are not. We can basically just ride out these fluctuations. We cannot chase hot stocks. All the sort of different behavioral elements that we've talked about not having action bias, not chasing returns, and that can be a source of edge. What that edge needs, and the reason that we want to read things and understand things, what that edge needs is for you to have built an intellectual framework that governs the way that you invest. So Phil's asking a question, are chartists flipping coins? I would say yes. So of course, there is this notion around, or there's this approach to investing called technical investing. And basically it's like reading a lie detector like result. Not that I know how to do that or read a chart, but yeah, you basically sit there and you look at a chart and you were supposed to find different things that could indicate where stock prices are going. So yeah, I personally think it's like flipping coins. What I know that it is that it is speculation, right? Because you are sitting there, you are not looking at the inherent value of any business. You are not an investor. An investor buys a business. An investor looks at that business and whether there are fundamental results from that business that are being used to identify good businesses, or whether it's more of a fundamental analysis. So it's not looking at factors and data, but an analysis. Either way, you're looking at a business. Anyone reading a chart is not looking at a business, right? Because I can put any chart in front of them. I wouldn't have to tell them what stock it was, and they would, do what they, and they would sit there and they would do whatever it is they do to try to identify where stock prices are going. All right, really good question from James. So Buffett has subsequently said that investing in the S&P 500 index fund is the best investment for an individual. Does that recommendation run counter to his argument in the 1984 paper? Yeah, I mean, I think it runs counter. So, Buffett has said for most people, as James put in here, for most people, the best thing they can do is, of course, go invest in an index fund. And he had this very famous bet with basically hedge fund to fund managers where they bet $1 million that was going to go to charity, that this manager couldn't go out there and identify hedge fund managers that would beat the S&P 500, I think over a 10-year period. And the hedge fund manager lost and Buffett won. So yeah, I mean, I think what I would say is that, Buffett, because despite his sort of folksy little charm, definitely has a little bit of an ego. What I would say, is Buffett was arguing that intellectually in a business school for professional investors, there is a way to beat the market. So, I think this S&P 500 he's kind of sitting there looking at the average person that's going out there and investing. And we've seen this, right? We've seen it through, and I didn't pick one of these as books, but Jack Bogle, and sort of his approach and the Vanguard approach, that for most people, this is this is not something you're going to do, that you're not going to beat the market. And it's better to focus on asset allocation, focus on savings, focus on longevity of investing. But, this is an argument for, hey, if you are out there trying to beat the market, trying to pick individual stocks, then what is your edge? In his case, he's looking at an analytical edge that he's describing. He's saying that this value investing tradition that came out of Benjamin Graham, that was the edge that people had from an analytical perspective. But yeah, I mean, for each one of us, we need to figure out, okay, what advantage do I think I have and how can I use that to beat the market? Okay, a really good question by Lisa. So Lisa sent me a great photo. I still need to write you back, Lisa, to 2 emails now. So I'm sorry. She sent me a great photo of one of her alpaca. Apparently they're getting fat. I think you used a better term for it than fat. I don't know if alpacas get upset, but Lisa's saying, is it better to buy companies that you understand or use personally, even if it means missing out on a emerging success? Okay, well, it's interesting. So once again, this is another book that I did not include in here, but Peter Lynch, and he wrote this famous book called One Up on Wall Street. So Peter Lynch was a portfolio manager for Fidelity. He ran the famous Fidelity Magellan Fund that did very well for a very long time. And he wrote this book, and his, one of the lessons from that is buy what you know. And, Buffett, I think, has done the same thing, Buffett has also done the same thing, talking about his sort of circle of competence. What I would argue, Lisa, is what we'll get into next, is you don't necessarily have to use the products. I think that if you're actually a consumer of something, that does give you a lot of insights into potentially competitive advantage that a company may have. And that can give you valuable insights. But I think it's about, understanding the business. And some businesses, and we need to realize this, some businesses are a lot harder to understand than others. And I think an example that we use back on a podcast is like a small biotech stock, right? It's very hard for me, if I'm looking at this business that basically is around finding cutting edge treatments for various diseases, me with no medical training, how am I supposed to go in there and assess if this, since we are where we are, this vaccine's going to work or this vaccine's going to work, and come up with and figure out, is that going to work? Is it going to get approved? Is it going to sell? It's very, very difficult for me to do that. It's a lot easier for me to go out there and figure out, okay, well, a new beer has come out on the market. I can go try it. I sort of understand a little bit more about beer because at least I used to spend time in pubs before this all happened. So I think we just have to think about how complex businesses are. And if you are trying to get analytical edge, if you are trying to figure out, okay, I want to come up with some insights that most people don't have, then that's very difficult to do in a very technical field that's outside of your own field and your own expertise. That's kind of what I would say. Lisa. Good quote by David. So if you cut out the roses from your portfolio, you are left with weeds. That's just good life advice, David, too, right? You could apply that to like friendship and family and people in your life. So good quote. All right. I like quotes. Okay. So this book is one of my favorites. And I know I talk about this all the time, so I'm sorry if it's being repetitive, but I still remember I was up in Maine, sitting by this lake, and yeah, this is where I read that book. Anyway, so Jeremy Siegel. So Jeremy Siegel is a professor at Wharton, University of Pennsylvania in Philadelphia, and I lived in Philadelphia briefly and did not eat enough cheesesteaks. I was thinking about that the other day. Did not eat enough cheesesteaks while I was there. If you guys have never had a Philly cheesesteak, not that you can get one now, but they are all they're cracked up to be. All right. So the future for investors. So this is kind of the notion that, Lisa, I think you touched upon. Basically, what Siegel did is he went back and looked at a bunch of market data. And he did a couple different, and I always talk about one part of this. I always talk about the best performing stock in the US, which is Philip Morris, the cigarette company from I think he looked at 1925 to the early 90s. So I always talk about that. But basically what he did is he went back and he looked at all sorts of different data. And I'll go through a couple examples of stuff he looked at, but really came up with this sort of hypothesis, a data-driven hypothesis, that boring is better. And this is the thing that I always harp on, that it's not how a company does in the absolute sense, it's how they do against investor expectations that matter. And it's why when you hear all these things and something becomes common knowledge, in my view, why it's not going to be a good investment, because it's all priced into the company. And even if the company does fantastic, you're probably not going to outperform a company that grows much slower, but is exceeding expectations. The other thing that he really talks about a lot is dividends and the power of dividends. So, as Australians, I can say we now, that I've almost been an Australian for a year now, that dividends are really, really important. And reinvesting dividends, dividend reinvestment plans applied over long periods of time to stocks that are fairly valued leads to enormous returns. And so he looked at a couple different data sets in this book, and he talked about all sorts of stuff. He talked about IPOs and hype and a lot of stuff that really resonates with me. But a couple different studies he did. One is in this quote that he looked at the original S&P 500 firms. So in the S&P 500, the 500 biggest stocks in the US first came out. He looked at who actually survived. And then he looked at the returns. So that's one thing. The other thing is he went back and he looked between 1950 and 2000 and looked at what actually performed well. So what did he come up with? He used a couple different examples. So I'll go through both examples because I think they're good and they're illustrative. So on one thing, so he's taking September 1st, 1950, that you look at two stocks. So Standard Oil. Now, Standard Oil was the old Rockefeller Oil Company that was sort of broken up and then reconstituted itself. It's ExxonMobil now, is Standard Oil. You look at Standard Oil and IBM. IBM, of course, and many people don't remember this now because others have taken over, but IBM for decades was like the cutting edge technology company. And so he went back and he looked at a couple different measures. All right, over the 50 years, he looked at revenue, so sales. And who did better? So IBM grew 12.46% over that 50-year period, which is very good, by the way. Standard Oil and, it turning into ExxonMobil grew 8.35%. All right, so IBM did better. So earnings per share. So IBM grew 7.39%. Its earnings per share. Standard Oil grew a little over 7%, 7.01%. The value, the stock price value. IBM went up 12.17% over that 50-year period. And Standard Oil went up 9.37%. All right, so the revenue grew faster, the earnings grew faster, and the price of the stock went faster. So which is the better investment? Well, the winner, of course, is Standard Oil. And what he did is he reinvested in both of the two shares. He reinvested dividends over that period. So why did Standard Oil win? Well, and we'll get to how much it won by in a second. It won because from P ratio basis, IBM was trading at just south of 27 times earnings. Standard Oil was trading at 12.81 times. That's average PE over that 50-year period. The average dividend yield over that 50-year period. So IBM was 2.24%. Standard Oil was 5.01%. So if you actually reinvested dividends, you would have accumulated 15 times the number of shares in Standard Oil versus 3 times the number of original shares in IBM. So even though the market value went up faster, you owned such a multiple of shares that you did significantly better from a return perspective. And so he goes and does this lesson like over and over and over again. And, Philip Morris is like the big one with cigarettes. But, he went back and he looked at the top performing companies over this time, over this 50-year period. Remember, when we're looking at Philip Morris, we're looking at a longer period. The top 4 were Kraft. All right, so they make cheese. Reynolds Tobacco, another tobacco company, Standard Oil, and Coca-Cola. And, his point was they all do boring things. They were all doing the exact same thing, on a wider scale and in more countries, but they're all doing the exact same thing. None of their businesses changed. They didn't acquire anyone really outside of their core business scope. None of their business changed. They were boring businesses, but they were all selling for cheaper. They all had higher dividend yields, and that led to better returns. So I really like this book. But yeah, it's a good one. Really influenced the way that I invest. All right, so we've got a really good question from Vincent. So he says, Peter Lynch, running a multi-billion-dollar fund, was able to interview the CEOs of any company he chose. How do we, as mom and dad investors, I'm really bad at saying mom. I can't get that. Like, the two things I'm not good at is that. So I often just switch to mother. And yeah, I'm not good at Z either. Ever hope to counter that edge? Okay, so yeah, let's talk about this. And let's talk about sort of the evolution of what has happened with investing. A huge edge that investors used to have was an informational edge. And it's exactly what Vincent outlined there, that you were able to go in and talk to management of a company. Now, you still can, but talk about the caveats. You were able to go in and get access to management when most people couldn't. Now, that has changed. Now, you can still go in and obviously talk to management, but they can't tell you anything that they don't tell anyone else. Now, that doesn't mean illegal stuff doesn't happen, but with a lot of the sort of fair disclosure regulations that have come out there, what used to be allowed is you could say whatever you wanted to whoever you wanted at the end of the day, if you were the CEO of a company. Now, that's changed. So what you were supposed to do now is you're supposed to present the same information. That's why when you go on to websites of companies, you will see all these like basically PowerPoint decks, which are the decks that they use to present to investors because they're making all of that information public. A lot of stuff is recorded. Individuals can join earnings calls and things like that. So yeah, a lot of that informational edge has, from a legal perspective, gone away. But that is where Vincent, where I would sit there and say, as the average investor, focus on the things that you can focus on, right? So maybe informational edge, which hopefully is mostly gone away, is not something that you're ever going to win at. Analytical edge may not be something you can win at. So are you going to be able to interpret that data better, build a better model? Maybe not. But what you can focus on is behavioral edge. So going against the herd, not doing what everyone else is doing. The structural edge, focusing on the long term. A lot of these professional managers, not Peter Lynch, although he had pretty high turnover. He traded more than most people, or than most people would think was healthy. But yeah, a lot of these professional investors have a lot of things going against them that it's their job and they have a boss on and they have to beat or at least get very close to other investors' results on a quarterly basis. They've got career risk that if they do something very different than everyone else and they're wrong, that's going to be a problem, right? It's better to be wrong doing what everyone else did than going out on your own, right? And they've got career risk because they have some big house and a family that they need to support. So that is a big risk for them as well. So I think it's just about looking at what our advantages are as investors. So Lisa's saying perhaps you have broader access to information across all forms of on-demand media to help counter the edge. Yeah, leading investment CEOs have had in the past. Yeah, and the one other thing I would say is, one of the problems is that I should have mentioned earlier is that, yeah, information is obviously disseminated now much more efficiently over the internet. So from a timing perspective, people are generally getting this at the same time. But the problem is we're overloaded with data. And it's a huge issue because most of the stuff that you hear is useless, right? And this is where, I kind of sit there and I see on some of these investing boards, what I always want to say back to people is, they'll come out with some sort of fact that everyone knows and then use that to justify buying something. And it's like, well, no, everybody knows that already. So do you think you're the only person paying attention to this? Maybe if it's like a very small cap stock, but if something comes out about BHP, like when people sit there and say, oh, the iron ore price just went up, you should buy BHP. You're like, well, everyone knows the iron ore price went up. What predict where it's going to be a year from now and be right. That is something that will give you an edge, not data. So I think people are, very influenced by data. So, and negatively, that they feel like they have to do something all the time. All right, moving on to our second to last book. So we're doing well. All right, so this is the little book that beats the market. And then, he came out with a second edition that says the little book that still beats the market. So this is a very easy read, and it's a very easy read because this was written for Joel Greenblatt's children. So I believe at the time I don't believe, I wrote it down, they were between the ages of 6 and 15 at the time. So he wanted to keep this very, very simple. And basically what this book talks about is something that he calls the magic formula. And I really don't like gimmicky things like the magic formula, but what is good about the magic formula is what it focuses on. So let's talk about the magic formula. So the magic formula looks at two different things. It basically just ranks shares against two different things. First thing is return on invested capital. Now, we talk a lot about return on invested capital here. We at Morningstar think this is a very important figure. Basically, what return on investment capital is it can indicate moat. So what you're looking at is earnings before interest and taxes. So EBIT, adding in depreciation. So of course, depreciation is a non-cash charge we want to add back in. We take out capital expenditures. So capital expenditures are what a company would spend for a big project, for example. And the idea is they can be very lumpy. So you don't want to necessarily include them. Like capital expenditure would be you need to build a new building, or I always use Qantas, or you need to buy a new airplane. That's capital expenditure. Then you divide that by net working capital plus net fixed assets. So working capital, we're just looking at sort of short-term assets and liabilities, kind of what a company needs to sort of keep going. And the net fixed assets is the asset base that the company is generating returns off of. So return on invested capital can indicate moat. Why? Because if you have a really high return on invested capital, it means that the money that you're investing in your business is earning outsized returns. And as people know, hopefully from these before, a moat means a sustainable competitive advantage. And what that means is that the company is going to earn higher returns than a company that does not have that sustainable competitive advantage. Their advantage will be competed away when they're out there competing. So I do the whole moat thing a lot. So if anyone has questions, just let me go. So let me know, not let me go. I can just go by pulling out that cord because there's nobody here to stop me. All right, so he looks at return on invested capital. The other thing he looks at is earnings yield. So once again, he takes that same thing, earnings before interest and taxes plus depreciation minus CapEx, and he divides it by the enterprise value of a company. So market value plus debt plus cash. So basically, this is kind of the inverse of a PE ratio. So what he's looking at is valuation. So he's looking at two different measures here, and he's come up with this kind of gimmicky formula. And what he's looking at is quality. So if we sort of break this down and not think about the financial ratios, he's looking at quality, which is return on invested capital. And then he's looking at valuation. So he's using one valuation measure. You could use another one instead if you wanted. But he's ranking companies based on those two things. And then he's seeing who sits at the top of all of them. So the interesting thing about what he's done is he started this website. So it's right down here, magicformulainvesting.com. So I went on to magicformulainvesting.com, and basically you register on the website. It doesn't cost anything, but you like give them your email address. And then you can go and basically run these screens on basically different universes of shares. Now, it's US shares, and you've got a choice of like the top 30 companies or the top 50 companies, and you get to select the market cap. So basically the market cap is how big the company is. So shares times the price. So I just ran the screen. This obviously is not advice or anything else, but I just ran the screen before we started this. And basically I looked at, so top 30 companies with a minimum market cap of $9 billion. So I wanted bigger companies, so stuff that we heard about. And this was the list. So basically it generated this list. And he's got this kind of formula in there about, you know, you buy, I don't remember the precise details, but you buy the top 30, and then you go in and wait like a year and then buy the next top 30. He's got something in there. But what I really like about this book is, number one, it's a really good way to start investing, start reading about investing, because it is, of course, written for his kids. And the other thing I really like about it is I do believe that it's not this simple, but that focusing on quality at a reasonable price is the approach. This is the whole notion that we have here at Morningstar. It's what I believe in, that you want to buy a great company at a reasonable price. And this, of course, is, you know, the same approach Buffett takes, you know, as he moved from like a deep value investor to a more of a growth-oriented investor. That was the approach he took. And so, yeah, I really like that lesson from this book, that, you know, maybe this isn't the best way to look for it. Maybe it's a little more complicated than this, but still, those are the things that matter. What is a great company, and how do you define a great company? In this case, he doesn't use the word moat, but he's using a formula, or he's using a financial ratio that has a lot to do with moat, the other one sort of being margin. And yeah, he's focused on valuation. So yeah, I like the book a lot. Oh, so Rodney is saying that there's an Australian ASX version of the Magic Formula investing site. So I did not know that. So it is shareranker.com. Okay, so check that out. So thank you for passing that on, Rodney. I should have known that. All right, we're on our last book, which is exciting. And yeah, we've got 17 minutes left. So it's not that quick. So sorry about that. All right, so the last book, and sorry, once again, it's a Buffett one, but it's just about him. He didn't write it. So it's called Snowball. And the book's a little bit insane, which I'll get into in a second. But none of the other books that are about Buffett, he played any role in. And so Alice Schroeder was an analyst that covered Berkshire Hathaway, of course, his company. And she got to know him a little bit, and she kept saying, like, you should write a book. Like, you should write a book, an autobiography, and, you know, people would be really interested in your life. And he eventually convinced her to write the book. And he cooperated with it and encouraged people in his life to cooperate it. So it's not per se a book about investing. It's really a book. It's a book about his life. Now, of course, and as you read the book, you realize how much of a focus is, his life is pretty much all about investing. So you do get a lot of different, investment knowledge, even if it's just not kind of directly given to you. And basically, and I'll go through some examples, but basically, you know, his sort of philosophy his entire life, to an almost insane degree, is the idea of like stockpiling money and then letting it compound. And he has this, you know, very early realization when he's like a little kid. He like figures out how compounding works and realizes the different inputs into compounding, one of which, of course, is time. And nobody ever figures this out when they're a little kid, mostly because they're probably out doing different things. But Buffett figures this out and sort of decides and has this singular focus that he is going to be rich. And the way that he's going to do it is by getting as much money into the market as early as possible and then letting it compound. And I think the really important lesson, we'll get into some sort of, interesting stories about his life, but the really important lesson to this is summed up by this quote right here. And of course, the title of this book, Snowball, is an analogy for compounding, right? So I know we're all in Australia, and a lot of Australians I know haven't seen snow, but a snowball, it rolls down the hill, it gets bigger and bigger and bigger because it's picking up more and more snow. And that is, and of course it rolls faster, that is compounding. And I really love this quote. It's one of my favorite quotes about Buffett because it looks at what are all the factors that matter. So you better be picking up snow as you go along because you're not going to be getting back up to the top of the hill again. That's the way life works. So that is this notion of time. It's the one thing we can't get back. So we can, over time, become better investors. But we will never get that time back that things can actually compound. So if you have kids or if you are younger, remember this because getting them to invest young is probably a lot more important than any returns are ever going to get because they compound over time. So just think about this and think about this understanding that Buffett picked up very early in life is what is the formula for getting rich? Well, the formula is returns are important, absolutely, but how much you save and how much time you have in the market are just as important and perhaps more important. So, we're all very focused on, okay, what are the little things I can do to get a little bit better of a return? But really, for especially young people, the best thing you can do is save money and get it into the market. So anyway, it talks about kind of his life. And one of the other quotes that he always talks about the $25,000 haircut. Now it's getting to the point where I would pay $25,000 for a haircut. But anyway, Buffett talks about that. And what he's talking about, of course, is compounding. That if he goes out and spends $20 for a haircut when he was, 20 or probably my age, that if he would have just invested that $20 instead, he could have compounded to the fact where it's $25,000. And it's all these like trade-offs you make in life, right? Like, I don't know, I obviously have nothing to do with Buffett. But yeah, I used to sit there and look at when I was younger, like, all right, I could go out for a nice dinner now, or I could go on an awesome trip in 15 years and like trying to, figure those things out. So just once again, kind of teaches up the notion of time. All right. So I promised you some crazy Buffett stories from the book. All right. So Buffett decided, as I said, that he was going to be rich. So at age 11, he declared that he would be a millionaire by the time he's 35. Now, remember, he's old. So $1 million is a lot of money now. It was really a lot of money back then. So he declared he would get there by 35. Well, he made it by 30. So good accomplishment. So by the end of high school, once again, a ton of money back then, he managed to save $10,000. Like the whole first part of the book is about these crazy jobs he had. Some conventional, like he was like a newspaper delivery guy, and some crazy, like he stole golf balls and then sold them. So criminal, I guess that's more criminal than conventional or non-conventional. So yeah, he saved $10,000 by the end of high school. So in the first 5 years of the 50s, and he was a young guy at this point, had not graduated from business school yet, he compounded his net worth 61% a year by investing, which is crazy. Like that is just a crazy amount. And then, of course, in 1956, he started his Buffett partnership. It's original investment fund from 56 to 69. He compounded it by 31% a year, which is also insane, but it also makes that 61% seem even more crazy. And yeah, and he's an interesting guy. Not necessarily that likable of a guy, some of the things that he does in his personal life. A lot of empathy, really, really does care about particularly people less fortunate than him. Doesn't so much care about his kids and has very little empathy for them and kind of ignores them. And he had an open marriage, which is the other really interesting thing about Buffett, that his wife, he couldn't really take care of himself. So his wife did everything for him. And then one day she said, all right, I'm going to go be a singer. And she like moved away, and then they had an open marriage, and his wife introduced him to this other woman who Buffett moved in with. And then his wife unfortunately passed away, and now he's married to the other woman. And they used to send Christmas cards with all three of them on there. So yeah, it's like a throuple or something, right? Don't look up that term, by the way. I should not have said that. But anyway, yeah, very interesting relationship. And yeah, a very strange guy that was like literally completely focused on being rich, like to a like obsessive degree. And the very interesting thing about it is not to be rich to do anything necessarily with the money. I mean, he remains famously very frugal, lives in the same house that he bought right after he got out of business school, like doesn't have any interests or hobbies really other than investing, and just literally kind of amassed this pile of money. And was just kind of done it to do it. And yeah, some weird like eating habits. So he's like very conscious about his weight, particularly before the annual meeting. And so he consumes only 1,000 calories a day, but he won't eat anything other than cheeseburgers and cherry Cokes. So yeah, a lot of very weird things. Yep, Phil's got a good expression. Money can buy anything except time. Exactly. And yeah, Elaine saying the importance of setting up goals in life. Yep, I agree. And I think, goals with all of this stuff, like, right, Buffett's goal was to be a millionaire by 35, but a goal obviously focuses you. And then lets you realize, hey, what are the actual things that matter? And, I think as 11-year-old Buffett probably would have said, well, okay, the first thing that matters to me now is the way that I can get rich is investing. The only way I can invest is if I get money. I need to go out and figure out a way to make some money. So, yeah. All right, we did it. Thank you guys for joining. I hope everyone is healthy and safe. And tomorrow I get my second jab. So that's good for me. I can go on a picnic. All right. Thanks, guys.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.